The stock market, it's a powerful force in the world. But did you know it started in a coffee shop? In 1602, the Dutch East India Company was booming. People wanted a piece of the action, so they met at coffee shops in Amsterdam. There, they bought and sold shares of the company. This was the beginning of the stock market as we know it. These early trades were informal, but they showed the demand for a structured marketplace. Investors wanted a safe and reliable way to trade shares, and they wanted to be confident in their investments. This need led to the creation of the first official stock exchange. The Dutch East India Company was a global powerhouse. It traded in spices, silks, and other valuable goods. The company's success made its shares highly sought after. This created a frenzy of trading activity in those Amsterdam coffee shops. This period marked the birth of stock market speculation. The coffee houses of Amsterdam became centers of financial innovation. New trading practices and financial instruments were developed. These early innovations laid the groundwork for the modern stock market we know today. The demand for a more organized system grew, and this eventually led to the establishment of the first official stock exchange. Amsterdam was the first. In 1602, the Dutch East India Company established the Amsterdam Stock Exchange. This was a major milestone. It formalized stock trading and provided a central location for buyers and sellers. London followed suit. The London Stock Exchange was established in 1773. It quickly became a major player in global finance. Its growth reflected the rise of the British Empire. These early exchanges were primarily focused on trading government bonds and shares of large companies. Across the Atlantic, the New York Stock Exchange, or NYSE, emerged. Established in 1792, the NYSE quickly grew in importance. It became the leading stock exchange in the United States. The NYSE's success was fueled by the rapid industrialization and economic growth of the nation. The NYSE adopted a physical trading floor. Brokers would gather there to buy and sell shares. This open outcry system was loud and chaotic, but it was the heart of the stock market for decades. This system fostered a sense of community and competition among traders. These stock exchanges from Amsterdam to New York became hubs of financial activity. They provided a platform for businesses to raise capital and for investors to participate in economic growth. The evolution of these exchanges mirrors the development of modern capitalism. At its core, the stock market is simple. It's a marketplace for buying and selling shares. These shares represent ownership in publicly traded companies. When you buy a share of Apple, you own a tiny piece of Apple. Companies issue shares to raise money. This is called an initial public offering, or IPO. When a company goes public, it sells shares to the public for the first time. Investors buy these shares hoping they will increase in value. The price of a share fluctuates based on supply and demand. If more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. This constant interplay of buying and selling determines the stock's market value. Investors make money in two main ways. They can sell their shares for a profit if the price goes up, or they can receive dividends, which are a portion of the company's profits distributed to shareholders. Understanding these basic principles is crucial for navigating the stock market. The stock market acts as a barometer of economic health. When the market is doing well, it generally reflects optimism about the economy. Conversely, a downturn in the market can signal economic uncertainty or pessimism. The interconnectedness of the stock market and the economy is undeniable. The stock market plays a vital role in the global economy. For companies, it provides access to capital. By issuing stock, companies can raise funds to expand operations, invest in research and development, or acquire other businesses. For investors, the stock market offers an opportunity to grow their wealth. By investing in companies they believe in, investors can participate in economic growth and potentially earn significant returns. The stock market acts as a bridge connecting capital with innovation. The stock market also promotes transparency and accountability. Publicly traded companies are required to disclose financial information to investors. This transparency helps to ensure fairness and instills confidence in the market. The stock market fosters competition and innovation. Companies listed on exchanges are constantly striving to improve their performance and outperform their competitors. This drive for excellence leads to innovation, better products and services, and ultimately, economic growth. However, it's crucial to remember that investing in the stock market carries inherent risks. Stock prices can be volatile, and there is always the potential for loss. It's essential to approach the market with a balanced perspective, understanding both its potential rewards and its inherent risks.